Oh, hello, everybody, and welcome to our Investor Insights. And today our host is Oliver Mitchell. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. And I also work with founders on their pitch decks and their executive summaries and make introductions to investors and strategic partners, which is very important these days, as Oliver will also tell you. And founders don't know how to write pitch decks; they really don't. And I want to thank Joseph Katz for hosting us. Joseph, tell us about what you're up to, what you do.
Thank you, Bonnie, and thank you everyone for joining. And looking forward to today's conversation. Just a scheduling note, I will be jumping off halfway through and making Bonnie the host, so I apologize for not being here the whole time. I help companies grow. I like to say help companies go from unknown to well-known using growth marketing, go-to-market strategies, and all sorts of fun marketing to make businesses go. I've been in the startup space for 15 years or so, and so excited for today's conversation. Please feel free to post all your information in the chat so everyone can connect afterwards because we keep the intros short.
Yes, we do. Speaking of, I see it's about to rain here, and sometimes I have low connectivity, so I might have to go dark, but I will still be here. So, Oliver, welcome once again. Tell us about you
Hi,
and what you're up to.
hi,
Do you want to
Bonnie.
go through the room first, or do you want to introduce yourself? And Oliver's an old hand at this.
However you want to proceed. I'm happy to start off with introductions about myself, and we can go around the room. Um, so my background is longtime founder, operator, built companies, sold them to big multinationals like American Express and Johnson Controls. And after my last startup, which was in the S.T.E.M robotics space, I started to write trade periodicals about the industrial robotics space, meeting great founders along the way. And I said, you know what? There's a real great opportunity here. So I created an investment vehicle called Autonomy Ventures. And from there, I had 8 exits, 2 IPOs, and 1 unicorn. And I also invested in a couple funds, Wyndham Ventures, which is on the medical device space, and also FF Venture Capital. Became very close to the partnership at FF, John and Alex, and got more involved as they made more investments in the automation space. And I've been there for 5.5 years. We're an early stage venture capital fund investing in seed stage companies around B2B SaaS, AI around fintech, insurtech, legal tech, prop tech, anything tech, and automation technologies, drones, robotics, IoT, remote sensing, and machine learning. I sit on a number of boards. I speak quite often about investing in the robotics space. It has its own idiosyncrasies, and that's why I'm writing a book, as Bonnie mentioned, called A Startup Field Guide in the Age of Robots and Artificial Intelligence.
Oliver was way early in the field of investing in robotics. I will also add that. Nobody was looking at it when you were investing, when you started investing in the space, really.
I've been investing in robotics since 2006. In about 2012, I started to do my angel investing, and people used to look at me like I was crazy. You know, I became known because my startup was called RobotGalaxy. It was in the retail space. It had a multiplayer virtual world, and it had an entertainment component. So I became known in New York City as the robot guy. Hey, there's Oliver. He's the robot guy. And then my marketing department created a blog for me, and they know I'm Jewish, and so they called it Robot Rabbi. And so I got a promotion. I became the rabbi of robots. And so a rabbi's a teacher. And so I was like, what am I going to write about? And so I started to write about the real industrial robotic space. And that, got me very heavily involved in looking at, mechatronic businesses and understanding, what these engineers are trying to change the world, but their business models are completely off. And just going back to them with first principles, whether it's a fintech company, whether it's a digital media company, whether it's a robotics company, first principles, and really, going through that. And I was one of the first people writing in this space from a business perspective. Everyone was talking about how great the actuation is, how great the end effectors are, the SLAM technologies. I was focused on what's the business model, who are the customers for this, how are they going to drive revenues, how are they going to expand customer lifetime value.
And I always include his posts in the newsletter. So let's do introductions. Ian.
Good morning, everybody. Ian Garmaze. I'm the COO of Virtual Film School. I'm based in Toronto, but the company is in LA. I'm also a co-op fellow at Laconia Capital right now. Happy to be here.
Thank you, and we're always happy to see you. Andrea,
Hi, everyone. Good morning. Hi, Andrea Liu, formerly trained in attorney practice, but for the last several years, I've been working for a Hong Kong family office in early stage disruptive tech investing. Thanks.
one of these days, I have to get you to be our guest investor. I know you're always traveling and you always have to go dark at some point. Eric, always good to see you.
Hi, how are you, Bonnie? Hey, Olive, how are you doing? Long time no see. So
My
I'm
fellow New York Angel over there.
That's right.
long time New York Angel, more
Yes,
than
he
10 years now. So I'm New York Angel, and I also accompany doing product innovation, and we involved in deep tech, energy, and all kind of consumer IoT and wearable technology. So I would love to talk to Oliver, update what he's doing. Pleasure to meet everyone. Thank you.
Yes, and Eric is being modest. He is an award-winning product designer, I will add.
Thank you.
Just true. Yes, it's true.
Thank you.
Nelson,
Okay, Nelson Hudis. My company is Hudis Communications International. I'm in Toronto. I run a PR firm. What that means is I get earned media exposure for public and private companies. I get them on the radio, I get them on TV, I get them into newspapers, magazines, industry publications. I've done PR for tech, medical devices, wireless, drones, mining, biotech, pharmaceutical, you name it, I do it. So again, I run a PR company and I get earned media exposure and brand awareness for companies. I'm the PR guy, publicity, and I'll put my information in the chat.
thank you. Tino, tell us what you're up to. We know, but go ahead, share it with the room.
Yeah, I'm Tino Go. I'm the founder and CEO of Baru. Baru is a gig platform for underused manufacturing automation. So we drive automation by selling custom cabinets. So think of it like Vistaprint meets Uber for machines to eliminate all of the long distance freight and warehousing that consumes 40% of industry revenues. We're post revenue. Sales this month will be around 100,000. We're anticipating between 5 and 12 million this year.
Good on you. Alex.
Hello, I am a former AI researcher and an entrepreneur. Just completed my second exit in January, so I'm looking at potentially starting something new. What's really interesting to me these days is how OpenAI, like LLM technologies, can make data science much cheaper and much more accessible.
I was just reading this morning how OpenAI had to just hire a phalanx of lawyers because there are so many lawsuits. You must have seen that.
Yeah. Well, here is the thing, you don't actually want to share any data with OpenAI, right? Like, so we're moving a lot of the logic to like local machines, and this is now pretty easy. So this way, data doesn't travel. And I mean, in fact, you never really want to feed data into the LLM. You just want to feed the schema.
Yes. Tell that to them. Tell that to Sam Altman. Steve P.
Oh, hi everyone. Steve Palking. I'm also from Toronto. My career has been in technology, sales, and marketing. I was at Samsung for about 12 years. I'm getting involved in the startup space. I guess my principal motivation right now is potentially to be a mentor to startups, whether or not they're at incubators or accelerators, with a focus around sales and marketing growth. Might be an investor later, not sure, open to joining. So that's why I'm here. Nice to see everyone and looking forward to the webinar.
Thank you. As are we all. Alexandra. Oh, you're muted right now.
Yes, sorry about that. Hi, everyone. I am Alexandra. I'm based in New York. I'm a consultant at Ernst & Young in the wealth and asset management space. Just interested in hearing about your experiences and what you guys do in the startup and venture capital sphere.
Well, welcome.
Thank you.
AM. And AM is muted right now.
Hey, hi. I'm Olok. I'm based out of New York as well. I currently head strategy at Plenty, a late-stage vertical farming startup.
Oh.
And prior to that, I've spent the majority of my career in product and strategy roles, building startups. I've had 3 exits, but curious to learn more about VC and Oliver's journey there, as well as his investment philosophy and thesis around that.
Thank you. I hope I'm not butchering your name. Bagudadi. Bagubadi. You're muted right now. No? Craig, I know you're not shy.
Thanks, Bonnie. Oliver, wonderful to hear your introduction. Looking forward to hearing all your insight. Joseph and Bonnie, thank you for including me as always. As you see behind me with the Lighthouse, just jumped into Chase Business Banking in Beverly Hills. Looking forward to seeing how I'm going to be able to bring a large brand down to a community level, which is where I've been focused for the last 25 years in regional banks. So I'm excited to bring a large product set to founders and startups because I think this is going to be a lot of fun. And Bonnie, as you know, with my artwork behind me, my hobby is that I call myself the AI disc jockey because my real passion has become AI artwork, both artwork as well as now creating motion. So having a lot of fun with it in my spare time. Thanks, everyone.
Oh, nice job. Ibrahim. I'm sorry if I butcher people's names. I'm trying.
It's entirely fine. You got it absolutely correct. I'm Ibrahim. I work in content marketing. I work with fintech companies in the seed and Series A space. And I'm excited to be here. Thank you, guys.
And welcome. Laura Lee.
Hi there. This is only my second time coming to your events, and I must say it's beautiful. Anyway, I'm here representing, I'm not an owner, but I'm representing a technology company, a new company. I put my links in there, and they're looking for investment, and it's a combination of taking all of the other types of sites and putting everybody in, having a one-stop shop where they can connect and sell their courses. And
Thank you. Maurice.
I don't know if I'm supposed to tell more or not.
Oh, no, we try to
would,
keep them short.
Okay, dear.
Thank you. Maurice. Oh, you're muted right now. Maybe it's a bad time. Sally.
Hi, I'm Sally Ricker. I'm the founder of the Project-Based Learning Company. I am on a quest to change higher education, and I've created a corporate project portal so companies can load projects, and then students can embed and access those projects into every single degree program. I'm really excited to build an educational alliance in the Middle East, working with Dubai first and building out an educational alliance so that Israel can be pulled into that, and we can make sure that those Abraham Accords stand strong.
Oh, thank you. Sandra, whose name I finally learned how to pronounce.
Hello, Bonnie and everyone. Good morning to some, good afternoon to others. I am Sandra Connor. I'm the owner of and creative force behind videogrows.com, where we get your messaging right for the right people at the right time. I have my contact information in the chat, as well as some other information that may be of interest. But the bottom line is we help founders and business owners to get their marketing message correct for the sales that they want.
Thank you. I hope I got everybody. I know the names keep popping around. So
Me?
with
Maybe very quickly.
Sorry, Aaron, you said you couldn't
Yes,
talk.
yes, I couldn't talk now. I'm able to. I had a bit of a longer call. So I'm Zarin, based in Switzerland, and I have a banking background, private banking. Currently, I focus on strategic partnerships and business development, mainly in financial sector, CRM management, and also e-commerce.
Oh, thank you. So questions for Oliver, unless you have something specific you want to talk about first, Oliver.
No, I'm open to questions. I mean, I can talk about, you know, holdings. I could talk about, what is a fund, how a fund operates. I can start anywhere. There's various aspects to a fund. One of them is raising capital, right? If you don't have steam in your engine, you're not going to go anywhere, right? And in many cases, who your LPs could also influence the types of technologies you invest in. So if you had a corporate LP that was interested in, came from the construction market, they might be looking at you as a discovery fund, and so they might bias you to go into construction technologies. An example of that would be, I think, Fifth Wall. They have a consortium of LPs from the real estate space, and which influences their investment portfolio within the built environment. And there's many other examples. And then, of course, there's deal sourcing and creating a great pipeline. Just having VC in your title, you're going to get lots flooded with emails and LinkedIn messages of startups, and they could very well be great startups. I mean, my mother was an antique dealer who sold to museums, but she would still go to the 23rd Street Flea Market every Sunday and look for hidden gems there. And so but at the same time, your best deals come through the relationships that you've been building for quite some time, and that are internal to the fund, whether those are former founders, whether those are colleagues and partners, and associates. And then it's operating businesses. And so like within FF, I'm really the only partner that's had operating experience, and I really get into the weeds of the business, and really trying to turn very engineering focused technologies into customer focused technologies. And so making, R&D subservient to sales. And so that the feedback loop of new products and technologies comes from the marketplace, not from sort of brain trusts of technologists. And so, and really growing that customer lifetime value with those core customers that are very, large, like a Chase there. I see the lighthouse there, where you can go across many different business units and offer opportunities there. And so, one thing, there's different stages of companies. Obviously, in the early stages, you're getting involved in so many different aspects of taking a product and turning it into a company. As they're scaling up, there's different needs, and sometimes the people that are really great at founding a company are not the right ones to scale a company, and those are some hard discussions to have. And as VCs, we don't like to do that, but we got to think about who the team is, because ultimately you're investing first in people, then product, and then the plan. And as the businesses mature, they could be making money and they could be doing great, but there might not be any motivation to liquidate. And at the end of the day, VCs are about making wealthy people wealthier. And so if you don't return capital, you're not going to, you're going to have a hard time, raising your next fund. And so you need to coach, founders on an exit mentality, and exits can take many shapes and forms, so, obviously, an IPO is a great exit, initial public offering. There was a whole bunch of SPACs. Those don't do as well because they don't have institutional following, right? They're a reverse merger onto the public markets through a shell. They tend to not have a lot of float. And that's why most of the SPACs pre-May 2021 have lost about over 90% of their value. There's private equity that, one of the best deals that I seeded on my own, not with FF, was Triple Lift. And that was a 3,500 times return over, it took 9 years, but it got sold for 1.4 billion. And there's still a little bit of cash yet to be distributed in that one. I was involved in the early days of founding ERA, so that came through there. And so I think that, private equity could be a great way. Also, growth equity buyout, where maybe they're not buying the majority, but they're buying out the, investors have been and some founder stock and employee stock that have been at it for a decade, and it becomes a great multiple. And once again, you can distribute cash back to investors. And then finally, there's other markets for your holdings as well, that if you do have very significant holdings, there's the secondary markets to sell, your stakes in them and so forth like that. That could also, those tend to come with a discount, but I'm always of the belief of a bird in hand is worth two in a bush. Other people might not agree with me, but that's just my belief. So it gives you like a primer on VC. There's other aspects to it, obviously.
Yeah, speaking of triple lift and pivoting, how many times did Eric pivot in those 9 years? And their exit was 4.1 billion, not 1.4. They had a really good exit. So
Right.
congrats to you.
Thank you.
Triple lift.
Thank you.
So
Yeah.
Ian has a question.
Oliver, there have been quite a few unsuccessful robotics startup companies that I'm aware of. How do you find the winners out of a lot of ones that really don't have a lot of potential, long-term potential?
Yeah, I mean, that's really a great question. So I would say that, first you got to get, depending on the stage that you're investing in. Obviously, in the earlier stage, it's a lot more psychologically driven investor where you're building trust with the founders, and you got to get really comfortable with the founding team and their expertise. Companies that tend to come out of academic labs without any startup experience tend to be higher riskier investments, just because the mission orientation of investing in a lab bench versus somebody who knows how to operate a company is very different. I think that within the robotic space, and this comes to what I'm talking about in my book, is that the customer discovery really has to be very deeply done, and that too many times that people get very excited by technology, and then they become a solution looking for a problem. And it's pretty cliche that gets said a lot, and it's just very true, is that people, great, technologists will come up with a great technology, but there's no real, no one's really going to pay money for it. And maybe they'll get some early validation from some big corporates, from innovation departments that are just looking to look under the hood, and it might throw them at like $100,000. But then they just stay in this pilot purgatory, and they're unable to, get any business unit, validation, or even to be able to do a pilot with the business unit that's responsible for P&L. So there's no, this happens a lot with autonomous vehicle technology, is that, that there's a lot of discussions happening with automakers out there on the pilots, but those are innovation departments that are completely removed from the business units, because the head of the business unit has a P&L he's responsible for. And the costs in the auto landscape has to be it has to be so efficient, and that you can't put a big full stack computer that costs more than an engine in a car, right? Just because it's autonomous, it doesn't scale. And so these things have to really make a lot of sense. And so that's I also think that good founders are very coachable. They listen to the market. I'll give you an example. Bonnie was speaking about pivots, and a pivot is by no means a demerit. I think it's a natural progression, an evolution of a startup. And so CivRobotics was originally founded as CivDrone, that's on the board of, and they do autonomous surveying. And they were going to do autonomous surveying with drones for big industrial projects. And the drone would go, it would land at a point, it would drill in a stake, and it was great. It had this whole stake apparatus, this whole gantry thing, and it was very cool. The drone was really big. And then, it was an Israeli company that came out of Technion. I brought them to Genius, New York. They were flying drones there. But when they went out to the marketplace, they saw that people who said, "Yeah, I love drones," weren't going to pay anything for drones. What's the problem with drones? Well, they got really short mission life, depending on the wind, it can be anywhere from 20 to 30 minutes. And so that becomes very inefficient if you have a big project. They also saw that one of the biggest opportunities wasn't industrial projects, but solar. And that with the infrastructure bill and the investment in renewable energy, solar developers needed a system that can go out to the Mojave Desert and do tens to hundreds of thousands of marks in a very short time period. There was a big bottleneck within that space of surveyors, that people are not going into it as a career, and there's a high retirement age. And so I think the average age of a surveyor is like 34, which is really old, like for a skill set like that. And so you're not getting younger surveyors out there. So developers had a real, couldn't start their job without putting the marking down. And so there was a real window of opportunity for Civ to come in and do that. In addition, a robot can, go 10 times faster, half the cost, and more accurate. And so that I think that they proved it out with 800,000 marks over 2 weeks that would normally take surveyors months to do, and a team of 16 versus a team of 2. And so they proved it out with a terrestrial robot that can go for like 9-10 hours at a time. And CivRobotics today, is growing their monthly recurring revenue at a very high pace. They're actually profitable, and the company is growing. Its technology is in Israel. Its core team is no longer in New York. It's actually in Silicon Valley, and they just launched a new product called Civ Dash, which is for road striping. And there's a lot of roads that need repair out there, and so it's a great example of a robotics company that listened to the market, that adjusted to the needs of the market. And I think that what happens a lot with robotics companies is that they don't do that, and they get stuck in this pilot purgatory. They also get stuck in just constantly doing feasibility studies without actually going out to the market and making money.
So customer discovery is the key.
It's one of the early keys. I think being a founder, you're like a jailer with lots of keys. But yeah, it's one of the early keys. Customer discovery is critical. I don't think you can't just stop there. You got to create that feedback loop there, and be able to implement that and be able to have teams that are listening to it. One of the things that Civ does is it takes its Israeli teams and brings them to job sites in California and Texas and Louisiana and so forth like that. So the developers are listening to the market.
But
I think also,
sorry, is
Civ,
that Civ
CIV,
Robotics?
yeah, CivRobotics,
CIV.
CIV robotics, yeah.
Sorry.
Yeah, and I think you want to create an incentive plan that is tied to around goals for everybody in the company. Yeah, so
Perfect. Thank you.
Oliver, can I ask for your firm, what are the average timeframes that you're looking at, either for exits or returns? Because I have an interest in what I would call hard to solve problems and patient capital, and robotics maybe is along those lines. I'm not sure, but just for your firm, what's the average timeframes that your investors are really looking to get involved in?
yeah, it's a really great question. So I'm sure you're familiar with the J curve, and by the time that you're going to start getting meaningful liquidity events, it's going to be later out. And I think that starts with seed, that seed investments, will take much longer. At the same time, for high net worth individuals, they're efficient from a cap gain standpoint because it's a qualifying stock business exemption. And that's a whole different animal, but basically no cap gains tax there federally. And states that follow the federal, like New York. And then I think, as companies mature, you might be able to hack that J curve a little bit earlier. So typically the liquidity events that happens in many funds very early get recycled before 3 years, get recycled back into the funds, and they don't distribute those. That seems to be something that the majority of funds do out there. The ones that happen, a liquidity event that happens between say years 3 and 5, they might be positive, but they're not going to be like the ones that are going to return the whole fund. And then the ones that are going to return the whole funds are going to take years 8, 9, 10, maybe 11, 12. They might outlive the fund, and they might have to extend the fund life there, because they might be in an undiluted basis be worth in billions of dollars, but you can't, that's illiquid. So until there's an event. So expectations, I think investors want, I think there's a few expectations. I think people that are not familiar with venture capital don't realize the lockup period are going to be very frustrated with the lockup period. It's not a hedge fund where you can get a redemption, by putting in a request 6 months before or something like that. It's not, so I think, if your LPs are not educated, it's going to lead to discontent. And there might be other fees associated depending on how funds are organized, like there might be audit fees, there might be interest fees depending on at one time, the LP comes in, that if they come at the end of the fund, they might have to pay interest charges. So that goes to the earlier investors and so forth like that. I think that so that will frustrate them more. I think the more astute investors that have experience in venture capital will they still want DPI, they still want distributions, but might be a little bit more patient. And then the institutional investors, will probably be the most familiar, and they'll be probably the most patient, as well as governments.
Zarin.
Hi. I had a quick question. I see that you had, successful exits on top unicorn. That's kind of everybody's dream. But I want to ask, when someone is building a fund, like, is your strategy more looking for good businesses and certain metrics that are more likely to succeed, or is there a method to, spotting a unicorn, or once you see one company is picking up speed, there are tricks, tips, techniques to make it, into a bigger company. How do you strategize your fund basically on these successful exits?
I don't fully understand the question. What's the question?
My question is basically, how do you strategize the exit? Like, when you start to look with the companies, do you try to look at possible unicorns, or you look at good companies and they sometimes turn out to be very, very successful, unexpected?
Right. So I mean, a few things. I mean, generally in venture capital, half the portfolio will die. That's not Oliver, that's the general venture capital. Then the other half, 25% of those will be washes. They'll be flat. Out of the next 25%, half of that will be a little bit better than a wash. And then the top 10 to 15% will be the ones that will return the whole fund. At the same time, every investment that I make, I want to build the company, and I want the company to be built in such a way that and my conviction is based upon the belief that this is a company that can do an initial public offering and will go public. I'm not building a company to sell the company in 2-3 years. If that happens along the way and the founders are like, you know what, we're tired, we want to do that. Okay, that's great. I will, coach them the best way through that. I will try to make sure they get more cash up front than earn out on the back end, because sometimes corporate partners are not nice about the earn out and they they don't fulfill the obligations there. And so, but I would say that you know, I might have missed before that liquidity events also through corporate M&A. That's kind of a big one. But I think that you know, you want to build your conviction based upon that this is a company that could be a multi-billion-dollar company. Period. I don't think you want to build it. You know, whether unicorn, soonicorn, this, but it's all BS. Just very simply, this is a company that JP Morgan could bring to the public markets, and it's going to be successful. It's that binary.
Okay, thank you.
Sorry, Alex, do you have a question?
Yes. So given your investment with Triple Whale, I'm kind of interested in I understand if you're no longer interested in the whole attribution market, but I'm kind of fascinated how the shutting down of the cookies is basically Facebook, Meta, Google trying to prevent anyone else from being able to do attribution properly. What do you think about that? Like, is there a future for companies that are trying to do attribution outside of the big tech data silos?
I don't fully understand the question. Can you just unpack it?
All right. So attribution is basically knowing what marketing led to actual sales.
Right.
And this is being done through cookies, where you can track a particular customer through a series of different touch points.
Right.
And then
So your question's
they
around
buy
data
something,
privacy? I mean,
my question is about the state of the market, because because this data silos are, you know, under the pretense of privacy, are basically just retrenching, you know, this large data players.
Yeah, I'm not an ad tech expert. Triple Lift was opportunistic investment based upon my involvement in ERA. I knew Charlie, Murat, and John. I was a mentor there, and it worked out very well. But I am not I don't feel I'm educated enough to adequately answer your question.
All right. Then the second question is, what topics do you find exciting these days in particular? What developments seem most interesting to you?
So, you know, obviously, you know, I'm bullish on automation. I think that if you look at the amount of construction of new manufacturing facilities happening in the US and in Mexico, it's at an all-time high. I think that you know, so smart manufacturing is a big aspect. I think if you look at the large consumer shift away from brick and mortar retail to online, so shipping logistics is really big. If you look at the population growth and the labor deficit in agriculture, so ag tech and automation around that is really exciting. And if you look at what's happening in the built environment and the disruption there, I think, you know, prop tech's really exciting and automation around that. And when you look at sustainability, I think there's a lot of interesting things happening there. You know, regarding that, I think, you know, obviously, artificial intelligence, machine learning, Gen AI, whatever buzzword is the flavor of the month. You know, I've been investing in it for quite some time. I'm a big believer in cognitive machines, and so I think that it gets really interesting when you take large language models and you combine it with automation. That gets really interesting.
By the way,
I think you know, drones, robotics, IoT, remote sensing, machine learning is really interesting. I would say that the following, though, I don't invest in technology, I invest in businesses. And so irregardless of whether it has .ai at the end of its name or what have you. It's about utilizing these technologies to accomplish a specific task that's going to improve performance, drive more revenues. There has to be an OpEx, outcome. It has to lead to a meaningful outcome for the business. It can't just be a beautiful machine.
Thank you so much.
Oh, thank you. Craig.
Thanks again, Oliver. So I'm going to jump in here and jump off, and maybe this will be a chapter that you already have secretly planned for your book. But it's interesting to me philosophically that you call yourself the robot rabbi, and yet
I didn't. My marketing.
Oh, no. I'm just saying, but you are in philosophically at the intersection of what has become this debate over the idea that you, in theory, are replacing individuals with robotics, right? So again, I think it's just interesting. I'd love to hear how you look at that, right? Because you really are at the forefront of someone that is looking at an industry or looking at individuals or the limitations of humans, right? Or human capital. And you know that you're able to put a business or replace that individual with a robotic or a robot that is more efficient. And so I'm interested to know how you look at that, and or will robotics, or when you're thinking about this philosophically, will there the ability for human capital to then return or be ancillary to the robotics that you're putting in place, or are the robotics a placement? I hope you don't mind early morning throwing that out, but you're in such a unique position that I'm interested to hear how you look at all that.
Yeah. It's a really good question. It's a question that people wrestle with a lot. And I think that the answer is not as binary as you would think. So one answer to that question has always been given, is ATMs. So ATMs were introduced in the late 1960s, and everyone said there's not going to be any more bank branches, and it's going to put all the bank tellers out of work, and et cetera, et cetera. And we know that, before the pandemic and the real estate sort of shift in New York City, every street corner, had a bank branch, and the tellers, were doing a lot more things than withdrawing and depositing cash. That banks had a whole bunch of products that these tellers were able to walk their clients through, and that it created a whole bunch a windfall for retail banking. And you were at a retail bank, so you're familiar with all the products and services that Chase had, that JP Morgan Chase has today versus Manufacturers Hanover who was the first bank branch to implement an ATM, and Manny Hanny was acquired by Chemical, which was acquired by Chase. And so you are a descendant of that history there. So that I would say that there along those lines with generative AI, replacing copywriters, let's just say, or Adobe's Gen AI platform replacing art directors. Now these are not blue collar workers; these are white collar workers. And so what happens to those people? I think that they get they go up the higher order, that routine sort of white paper copywriting, that's on everybody's website, like a Fiverr logo, is done by a machine. But that really smart, intelligent, insightful copy that's in advertising or in literary materials or in entertainment, that is where a human provides, maybe gets even a little more competitive. Maybe mundane TV shows, are no longer, and that they're a lot more insightful and a lot more creative, in the same way that there's a lot more selection today with over-the-air offerings with Hulu and Netflix and etc. So I think that, yeah, there's going to be a lot of displacement, a lot of shift, but at the same time, anytime that there's shift, it's not like it's in a vacuum. There are people that'll be hurt, but there'll be also opportunities that'll be upstream that we don't even know about now, and it creates that. I think that as an example, like specific to automation and what I was saying before about manufacturing, is that so much of manufacturing, and I used to be in the toy business, what it was done is done in Asia, right? And it brought down the costs. A TV set, flat screen TV set was in the hundreds of dollars versus the thousands of dollars. And the drop of television sets dropped substantially, as well as computing devices and everything like that. And so I think that from outsourcing to contract manufacturers in China, that brought that down. Now, how can the US compete against that? Well, maybe by doing smaller inventories, closer to the consumer, and realizing that by automating, that you could take your labor force and you could offset that to make it a lot more efficient from a margin standpoint. I think that also a big driver of this, Craig, is not that there's in manufacturing there's a growing labor workforce there. There's actually a declining labor workforce there, or in construction, with trades, and so there's a skill deficit. And as we saw, that there's actually underemployment, where there's jobs available out there where people, for certain skills, where we don't have people filling them. And that's where machines come in, and that sort of exacerbates the push to automation, and people get really impressed by that, like in my case of the surveyors, or other things. And then there's also the third rail, which is dull, dirty, and dangerous. There's lots of jobs out there that humans have been doing that are really dangerous for humans to do, that lead to high worker comps claims, lead to high injuries and even fatalities. And so that's really the sweet spot for automation. And we saw that with space, right? We couldn't really send a human being, or we could send a human being to Mars. We couldn't successfully bring them back. So we created a robot for, to survey Mars. And that is created, through curiosity and spirit and opportunity. The whole space program in the United States has been revolutionized, and it's been added to becoming an industry in itself, with commercial space, a low Earth orbit. And so we're seeing now that those technologies are actually creating a lot of human labor as well. And so it takes a lot of human beings, really smart human beings, to make robots and to bring robots to market. And so, to answer your question, I don't think it's like, the robot overlords, and there's going to be a whole bunch of humans, unemployed. I consulted on an article for the New Yorker, and the cover of the New Yorker was humans panhandling with robots walking to work. I don't think it'll be like that. But I do think there will be displacement. Andrew Yang wrote a book all about that one before he ran for president. I do think there'll be a great displacement, but I also think that we're seeing that today with the democratization of mobile technologies and like Shopify and Etsy, providing opportunities for people, that people, that their father worked in a factory, but they can sell belts on Etsy and make the same amount of money. So why go to a factory and hurt myself? I can stay home. I can go hiking with my girlfriend. I can make all this money selling belts that people want in small batches on Etsy. And so we have this Etsification of America, where people are not showing up to do plumbing, and not showing up to do construction, not showing up to do manufacturing or logistics or truck driving. And they're staying in Montana and getting a good quality of life and building and making belts. So.
AM has a question. Then I have a
Yeah.
comment.
Yeah, Oliver, maybe a more practical question from me is, how have you gone about sourcing your best deals? Are there any specific actions you've taken to get yourself in front of those founders or businesses that you've appreciated the most, or found to be the most exciting at that early stage?
The first thing I did was subscribe to Bonnie's newsletter, because everyone should be a reader of that and digesting that, because you will find the epicenter of startups and there. I think you gotta, each of you, if you want to go into this business, got to build a brand for yourself that puts you in the center of the equation. And so, I speak quite often at trade shows. Afterwards, I get inundated with great founders. I'm pretty highly visible and really create a great network with corporate partners, and next time around, founders who either I backed or I didn't back, but I've stayed close relationship. I always try to help people on a call. Sometimes my helpfulness is honest candor. It might be hard to hear, but I hear back a few months later, like, wow, you really helped me. Thanks so much for that. And so I think that through that, creates, a flywheel of opportunities that are really highly qualified, high quality investments that you can get conviction around. And so once again, you're going to get a lot inundated cold, but really the ones that you're probably going to spend the most time with and the most meaningful ones will come through your internal network. And so you got to build that network of trusted partners and advisors. So right now, ffVC doesn't finished investing out of its 6 funds, so I don't actually have a vehicle to invest out of. So I'm getting deals, but I'm sharing those with other VCs out there. And you scratch my back, I'll scratch your back. So when I do have a fund, that to invest from, that they're going to send me deals. So as an example, and trying to help those founders out too.
I know Ian had. Did you finish? I'm sorry.
I did, yeah.
Okay.
Thanks.
I know, everybody's all over generative AI right now. And I remember when Amazon was automating the stores, and it was like, just walk out, just take your stuff. And I was reading today that that's going away because it takes so many humans and it's so complicated. They probably hired more humans than they had working there before the automation. So do you see that happening in other sectors as well? The big problem.
Well, when Amazon first started, and a great book is called The Everything Store by Brad Stone. It's actually in my curriculum. I teach a course called Entrepreneurship and Management Change at Syms, an MBA course that's in my curriculum there. But so they actually, one of the big things about Amazon, even in the early days when it's just doing books, was the fulfillment center. Everyone thinks of Amazon, the reviews were very important. Taking a look inside the books, the previews of the books were very important. There were so many things, but the fulfillment center and hacking the fulfillment center was critical. Now they realized that the key thing was the speed, that it couldn't, in order for people to have trust and wanted to reorder, you had to get that product, then that book out to them to turn around really quickly. And so they used to have people, now a fulfillment center, I don't know how many of you guys have been at a warehouse, but it's like 3 football fields long. So it's really a long space. The first one was in downtown Seattle, was in the basement, and then eventually got like a big warehouse. And there's these carts, people would push you going down football fields, picking up books, going to shelving, finding it, They thought to speed it up, well, why don't we have people on roller skates going around the fulfillment center? And they realized that was a really bad idea. It led to really high worker comps claims and so forth like that. But they did acquire a company. Kiva Systems. And what Kiva is, it's a robot that goes underneath the shelving and brings the shelving to the picker. So no, the picker doesn't need that cart anymore. Doesn't need to walk 300,000, square feet, like the equivalent of like 3 miles and probably 20 miles a day, that they could just stay in a station and pick the items to pack it, tape it, label it, ship it. And Kiva actually came out of another company. Does anybody know what Kiva Systems came out of?
No.
So Kiva Systems was purchased for $775 million in 2012. But Kiva's technology was used by a company that went public for $800 million in 2000 and was the biggest .com bust called Webvan.
Oh,
And Webvan talked about customer discovery, did no customer discovery. It said, I know what the consumers want. They want to order on a website. They want groceries to their door. Makes sense, right? We all use Instacart now, right? And we're gonna and before we're gonna market it and do a national television commercial, we're gonna build the best distribution center there is, and we're gonna invest in technology. And they did. And they spent $800 million for 10,000 customers that they had, and they went bankrupt. But the Matt Marks, who was an engineer there at Webvan, he realized that there was something there. He built Kiva, and so Kiva then built up a really great base within warehousing. And Amazon knocked on the door and said, you know what? We want to acquire you, $775 million, just $25 million short of the IPO price, in 2012. But we want you to do one thing. We want you to fire your customers. And so we want Kiva as an exclusive added advantage to Amazon. So going to your question, you would think, well, they got Kiva, and now they have other robots. Why do you need millions of workers packing boxes? Because they got higher demand because of the robots. So you need more people there. And so it wasn't like the robots displaced the people. The robots actually augmenting people and robots actually increased margins, increased sales, enabled free shipping, enabled Prime, enabled quicker turnaround, which created higher customer satisfaction there. And so it became that virtuous cycle.
Oh, I meant the front end. Oop, go ahead. The front end where they're, the front end. Was
The
it doing
front of
like,
it.
the just walk out? You can't just walk out. I meant the front end.
Amazon Go.
Yes.
Right. Yeah, I mean, there's Amazon Go. I think the main, where I've seen the most Amazon Go now has been in airports. I don't know if any of you have seen that, but and it's really convenient in the airport because that's always a bottleneck, is buying a bottle of water and sitting behind, somebody from the Midwest who's counting out their pennies and as you're trying to catch a flight. So and being a New Yorker, you're biting your teeth trying to be patient and so forth like that. But so yeah, I mean, it is kind of interesting. It will displace cashiers, but you still need people to stock the shelves. So if you have higher throughput, you're still going to need people to stock the shelves. And then when you automate that, you're still going to need other people there and so forth like that. So I'm sorry, Sally, you're from the Midwest. I love Midwesterners. You're really using your noggin there. I would say that it's going to be a labor shift. I don't have an answer for you. I do know that Whole Foods doesn't run on Amazon Go because Amazon Go has a capacity issue because it uses computer vision up in the ceiling to see everything. And if the store is too crowded, you can overwhelm the system and you can lose sales. So that's why it's been in these smaller convenience store things. Bonnie's turned green.
No,
the
I'm
money.
sorry. I'm here, don't worry.
Okay.
It's whenever it rains, I get this, low internet message. Ian, thank you.
Yeah, Oliver, what are
raining?
your thoughts on the current opportunities in ed tech? There's been a lot of disappointments there as well.
Yeah. Once again, ad tech is not my main area.
Oh, sorry,
while
no. Ed tech.
Oh, education tech. That's also not my main area. I've had a foray in there and sort of like that. I think ed tech is really tough because I think it's disenfranchised and selling into schools is really tough. And I think the people that have done it well are able to do a consultative sale to supervisors and say, listen, if you buy my technology, you're going to be able to access this much more of federal dollars or state dollars. And so it's a win-win for everybody around. But I'm not adverse enough to, answer your question with any intelligence.
Thanks. Yeah.
Oh, sorry about that. Laura Lee.
Hi. I'm not quite sure if I'm allowed to ask this, but here goes. Is there a way that you're open for people to send you a pitch deck from a company for you to look at?
Sure. Right now,
Are you open to that?
I am open to that. You can, send it to me, Oliver Mitchell, on LinkedIn. You can email me, oliver.mitchell@ffVC.com. Go to robotrabbi.com, and all my stuff's there too. Not my email, but on LinkedIn and Twitter and so forth. Yeah, so I mean, I respond to everybody. As I said before, I will say this right now, sort of in between funds, so I don't have a platform to deploy capital, and so I'd probably, if it's something relevant for a colleague of another fund, I'd probably forward it to them. And if I really like it, I might go back to the founders and say, have you thought of X, Y, and Z? But I don't have a platform to readily invest right now between funds.
Are you raising the next fund now? You must be.
Yeah, I don't want to get into the
Okay.
details of FF and stuff like that. So yeah.
Just curious.
Bonnie, I have one more. Bonnie, I have a question. Is that okay?
Oh, sure.
Oliver, you talked about deal sourcing. My perception or observation is that incubators and accelerators are growing in number. I don't know, popping up like spring flowers, it seems. What percentage of your deals come vetted through incubators and accelerators versus through well, maybe through your network first, but they've been vetted through an incubator or an accelerator?
I mean, a number of them, I would say. I don't know the percentage, but I think that a number of them always, have already been. I'm a big fan. I think they can really help a company a lot. But they're not homogeneous. You know what I'm saying? They're very different. So like for companies like that are deep tech, they might go through a government like AFWorks or something like that, and they might do a lot of stuff around DARPA and the DoD, and that might give them access to great capital, non-diluted funding, and so forth like that, and really give them a high value customer where they can really kick the tires and improve the technology. As mentioned before, CivRobotics, I brought to Genius New York, which is an accelerator 4 hours north of here in Syracuse, because they are attached to Griffiths Air Force Base to be able to test drones. And so they're the largest accelerator for uncrewed systems. And once again, that's non-diluted capital. ERA is a great source of companies for FF historically. I'm more of a B2B investor, and ERA is more shifted to B2B than consumer, but ERA has Capital Factory in Austin, does so many deals that it'd be hard not to do it, look at deals from them. Mass Robotics in Boston, which is an incubator there, I think is really great. I think, there are companies that I meet with that are too early for venture capital that I say you should go to an accelerator. Have you ever thought of this accelerator or that accelerator? I think it has to be a good match to the startup. I think where it gets detrimental is where you see, 4 logos of accelerators like Techstars, New York Techstars, Missouri, et cetera, et cetera. And then it's like they're in a perpetual incubator. It's sort of like purgatory there. They're never getting to their goal. So and it says that they're not able to raise that next round. Obviously YC is a great accelerator, but not every YC company is a great company. And if I'm seeing a YC company in New York City, then I have to question why am I seeing a company that had an amazing audience of investors that they would have scooped it up really quickly, So these are questions you need to ask yourself. I think they could be very additive. Is it a badge of honor in the deck? I don't know. I weight it as I weight any other data point. But I think it has to be a good fit and it has to accomplish the goals more than just doing a nice pitch deck. It really has to accomplish a commercial deployment and sales.
So Chris Sorensen just joined us. Chris, you want to introduce yourself? You're muted right now.
Yeah, I'm muted. Sorry. Yeah, I'm on my phone. This is a fantastic discussion, and Oliver, I'd love to chat with you offline.
Okay, sure. My email is in the chat.
Yeah, I know Chris. He's an investor.
Yep. And I'm in the car, so it's a little bit hard to chat, but I will catch up with you guys later.
Okay, thanks. So I was just reading that that pivoted away from cars, but Apple is now working on robots for the home. And what I read, it said that they're going to follow you everywhere. We know about privacy and surveillance and blah, blah, blah. I mean, what do they think? What do you think about that whole thing in robots? And I know you've had Roombas forever, but what do you think about all that?
I'm actually working from home and I can hear the Roomba in the kitchen going right now. So I know the founding team really well of iRobot. On a side note, iRobot sort of got screwed by the European trade commissions there of blocking the merger with Amazon. I think that Apple has well, not speaking about Apple specifically, but I think the home is the most difficult environment to build to, putting aside the data privacy issue. Just that in the case of the Roomba, I need to take the chairs off the floor and put them on the table so it can go underneath the table, right? I need to prepare an area for my robot to work in that area. Now, what does that look like for your kid's room with toys being left on the floor or something like that? A pile of laundry, a cable that gets caught in a Roomba or a home robot. So I think that there's lots of great applications that can come from it. I would say more than Apple right now. I could predict that Apple, now that iRobot is, that's lost a lot of its value, but iRobot, is basically an M&A candidate. And I could predict that Apple might want to acquire them because it's a great indoor mapping system. And it's a great base to build out robots. If you go to any lab, they're always using a Roomba as the base of their early robots. I would say that the company who probably has the leg up, literally, on the home is Tesla, and Optimus. So I don't know how many people have seen the Optimus videos, but they're extremely impressive. They're impressive not based upon they're doing something new, because there's other robots that have done that earlier, but just the speed of development of Optimus. Now, you have to realize Tesla has the most amount of growing training data in the world, because every Tesla car has cameras that go back to the mothership, and so it's monitor. They can monitor humans on every walking by on every corner and stuff like that. They're not in the home, but they know enough about human behavior there. They also have great access to technologists, to data scientists, to mechanical and electrical engineers, via Tesla and SpaceX. They know how to build something at scale that could be affordable. So it could be very feasible that an Optimus robot could be offered to people for the price of a housekeeper or a nanny on a monthly basis. That could be possible. I'm not a fan. There's some humanoids that gotten some great valuations out there. I think it's kind of a high-skilled, overpriced piece of equipment to move boxes around a warehouse. I don't think the human form is the best form for moving boxes to begin with. But I think that people, on the masses want a humanoid that it looks comforting. Optimus looks kind of scary, to tell you the truth. But that's why Pepper, which was one of the first robots, humanoid robots out there, it was 4 feet, looked kind of cute. It sort of died. It's never had really significant sales. It was owned by SoftBank. But I would say that there's a growing interest in humanoids. Obviously, Jensen Huang displayed 12 of them at his keynote on a video. I think that one final piece is that it doesn't necessarily have to be humanoid. Like the Roomba, they didn't create a humanoid robot to move an upright vacuum around. They thought about how would a robot accomplish this task, and so you potentially could have task-driven things that in people's lives, which could be very additive to people aging in place who couldn't operate and a vacuum, or couldn't walk efficiently to go get something or something like that. So I'm sorry to be long-winded here and answer your question, but I'm sort of shooting off the cuff here. But I would say that it is foreseeable that you're going to see a lot more home automation. There's been a lot of mobile robots. Amazon had Scout and stuff like that have come and gone. But Optimus would be one that I would track.
Funny, we've had a Roomba sitting in the closet since like the beginning, because my husband does not want our house mapped all the time. He refuses to put it on. He's a techie. Anyway, does anybody else have a question? I don't mean to monopolize anything here. No questions?
Well, I'll ask you, since nobody
sure,
else.
ahead.
Oliver, what is your assessment of the current state of VC? I mean, I've heard a lot of negative comments from some people, including on this call.
And zombie funds.
Yeah, I mean, what do you think?
On this call, was I negative on VC?
No, not you. I don't mean this call. I mean the previous editions of this.
Okay. Oh. I am, positive and bullish on VC. I think as an asset class, alternatives make a lot of sense. Depending on people's wealth, should it be the only thing they invest in? No. Should it be invested in a diversified portfolio? Yes. And I will let the wealth managers here who can advise you on that, but I would include alternates in that mix there. I think it can provide that sort of multiple on a long tail basis that can be very meaningful. But like any asset class, there are cyclical trends that affect it. I think that you have many managers. I have some racing stripes, so I've been around for quite some time here. So, but you have many managers who've never seen a down cycle before, and they're getting spooked. And so Personally, I think now is probably the best time to invest. I think adversity breeds creativity, and that's why 2008 was one of the best vintages for VC. Uber, Airbnb, others. And so I would say that my mentor's Howard Morgan, and he invested in so many companies in 2008. That are all top leading publicly traded companies. And so I would say that it's a very valuable asset class. There's lots of opportunities now, but I think that people who are not used to market shifts, that the climate questions their belief. When things were easy, they were very very enthusiastic, but definitely if it wasn't hard, they wouldn't call it work.
Yeah, I was just reading that Q1 VC expenditure in the US is down 29%. That's that I work with founders, and lately I've been shifting towards introducing them to partners who become clients, and usually it's the partners who are putting in the money, not just through sales or using the technology, but their VC funds. They usually have investment funds as well. So I think founders have to shift their thinking as well.
I think founders have to decide who they're looking for as an investor and what they want to accomplish. And so I think VCs are immensely valuable to a startup. We provide a lot of intangibles. Every VC has a different flavor of what they provide. I think they provide a lot of validation and support for that investment thesis. And I think angels are helpful, but they don't provide those other things. And so I was advising a startup, an Israeli startup yesterday, and he was at a high valuation. It's a technology coming out of the Gaza war. And, so it's already been used in the field and everything like that. And so he feels like it's not really a pre-seed round because they've already, the company's been around, the IDF seeded it. And so and he's raising, a high valuation with angels. And I said, you should really, have some local VCs in the round, because by the time it comes to the US, people are going to go and question, like, why didn't, there's enough VC capital locally in Tel Aviv. Why didn't anybody invest there? So, and I think that it would come at a cost of that high valuation, because there's no way I can make a multiple for my LP on such a high valuation, based upon just because of the battlefield success is really great for technology, but doesn't drive a commercial P&L. And so that's very different, unless you're defense innovation, and this wasn't going into that. And so I think it'd be worth it for that one company to do a smaller round at a lower valuation, to have some more recognizable names on the cap table.
Any other questions or comments?
I'm out of coffee, so we must be out of time.
Oh no, we're almost out of time. Any party, since you've been investing a long time, Oliver, and I know that, both personally and as an LP in funds, and are very involved in accelerators. I see you at ERA demo day every single time, and I'll see you in 2 weeks, I guess. So, any last minute advice in this strange time in our industry? Which I don't know, it's such a strange time, because you and I have been through down cycles before, but a lot of people haven't.
I think people just got to follow their passion, and invest in that, So if their passion is for startup innovation, and they like consulting, on marketing, then they should do that. If their passion is about, investing and finance, and they really want to build great value, then venture might make a lot of sense.
So we have a few more minutes if anybody has one last question or comment. Ian, you always have something to say.
Well, I mean, I found your comments very insightful, Oliver, and it's kind of a breath of fresh air because not excessively positive, but not very negative as we've heard from some others. And I like your focus on hardware. I mean, I think, as you said, hardware was not a popular area for a lot of firms to invest in, but you've done it, and you've obviously done fairly well with it. So I appreciate that.
Thank you. I think Sally was going to ask you a question. I think she took up my. Yeah.
Yes, and Laura has a question, so go ahead. Oh, you're muted, Sally. Oh, we still can't hear you. Uh-oh. Gotta love tech. Laura, do you want to ask your question in the meantime while Sally sorts out the tech?
Okay. I was wondering if you could give a little bit of guidance as to how valuating a company. I had the pleasure of being a certified financial planner for 25 years. However, I invested in mutual funds and banks and did insurance for people and for businesses. I'm now helping a company voluntarily to look for funding. But this is a whole new realm of industry of information that I've never been part of before. I know a tiny little bit, but do you have any suggestions, like as an example, that, oops, it says I'm speaking French. I don't think so. Of where a company should look at, as an example, the company I'm representing, they feel very much they'll be a billion-dollar company very quickly and easily within the next year. However, how do you look at that company? You have to base it on their sales right now, is my understanding, where they are at the moment. How come?
Just curious. We're going to be $1 billion company in a year. What are their sales now?
I don't exactly know their exact sales right at the moment, but they hired Frank Frausto Jr., who he used to work with Google for 15 years. And the last company he helped look for clients, it took him 90 days to bring in 1.7 million new customers to the company. And they're looking at a sales of $20 to $50 a month as far as product for the average person. $100 if they want to host their own product to be sold, like their own courses to be sold on that.
Got it. It seems a little overambitious, but okay. I'm not familiar with the gentleman or the company, but I would say first and foremost is people, then the product, and then the plan is how you analyze on the early stage. I think on a later stage, you do more sensitivity analysis about the product and the plan. But just focused on early stage, you have to get comfortable with the people, their integrity, whether they're coachable, whether they're the right people to steer the company, whether you are aligned with the business objectives, and you got to validate everything. And so, like, I assume that everyone's BSing me, and I'll go to the sort of empirical data. I'll go to the bank statements, the tax returns, and so forth like that to see, what is the cash position, what are the real sales, and so forth like that. So, Ian said, I've been straightforward. I'm a pretty straightforward person. Hopefully, I'm an optimist, but I'm not Pollyannish, and so I do get excited by companies and founders, but I don't fall in love. I'm in love with my wife, who I've been together with for a very long time, but I don't fall in love with founders because I have to be prepared to walk away from the deal. And so I think if you go in with blinders and you believe all this stuff, like the $1 billion in sales within 12 months, which I think would be an amazing record. That it would you can lead to overlooking some important aspects. So Sally just texted her question here. My expertise in education, not business. What is the VC perception of a founder in this situation? Should I continue to look for a business partner or find an investor that will guide me in business aspects of growing my company? So I assume that she has an education related business that she wants to grow. I don't know what the company is, but I do think that single founders are not as strong as partners. So I would say that it's probably very good for her to look for a partner, and it's probably the toughest decision that she will have to make in this in her startup, and it has to be the right complement of strengths and opportunities where they can grow together. It's 11 o'clock, Bonnie, and I have a call now.
Me too. Thank you so much, as always. I'm so glad you came and spoke with us again, and I will see that.
Please. I interrupted you, Bonnie.
I'm sorry. I said I'll see you 2 weeks in 2 weeks at ERA demo day. No,
I will most likely be in Israel then. But
that's right. I forgot it's the holidays too.
Yeah. But I look forward to the recap on your newsletter, and everyone should subscribe, and everyone should hire Bonnie for all their materials and not ChatGPT. And so I want to thank everyone for their time. I put my email in the chat. Feel free to reach out. Any additional questions, any pitch decks, and I'll try to get to them. And thank you very much. And
thank you so much.
Have a great day.
You too. Thanks, everybody.
Goodbye.